Hello everyone, my name is Amit Ashok Chawla, and in this particular discussion I would like to share my perspective on the most recent standard issued by the International Accounting Standard Board, which is IFRS 17 insurance contract. Friends, you may be aware that the insurance industry is one of the most regulated industries in the world, for the simple reason that first of all, it is a lot of money, like the way the banks have it. And also, even more important factor that comes in play is that an insurance company needs to manage, a lot of reserves, considering the fact that it's all about the people's money, and they have put that money into the insurance company, considering the fact that if something goes wrong with them tomorrow, the insurance company is there to help them. So effectively, the standard tries to address the kind of risks which are attached to any insurance contract, normally written by insurance companies, and bringing a fundamental shift in the accounting, the way IFRS 9 brought it to the banking industry, right? You would be aware of it under IFRS 9, hedge accounting, the calculation of expected credit loss, the provisioning part of it, classification of financial assets and liabilities. They were all so significant there, right? That completely, changed over the accounting and the recognition and measurement requirements under IFRS 9 for the banking institutions. But so is the case as far as IFRS 17 is concerned towards insurance contract. Now, largely, this standard would be applicable to insurance companies because they are clearly writing those insurance contracts. But even even a company which is not into insurance business might be writing an insurance contract itself. I mean, imagine an example that you get into a contract for roadside assistance. You buy a car, and one fine day you receive a call from a company, and it says that, look, we are providing a 365 days on road or roadside assistance, where we say that if anything happens to your car, it breaks down, there's a flat tire, it requires some repair, we will provide those you know uh, services, taking it to or towing it to a garage, or maybe doing an instant repair and stuff like that. Believe me, technically speaking, it's an insurance contract, even though that roadside assistance company or the on-road assistance company is not an insurance. So there is a possibility that such contract gets covered under this particular standard. You're buying a mobile phone, and there is a warranty given by, let's say, the manufacturer or dealer, or let's say even it could be towards an insurance as a cover. Now, that again meets the definition of an insurance contract, but that mobile company or the dealer is not an insurance company again. So how do you deal with those aspects is something which IFRS 17 tries to do. So essentially, this is a standard which has a much wider scope than only becoming applicable for the insurance company. Okay, with the kind of money invested in insurance business, with the kind of stakes involved, with respect to the risks that these insurance companies are taking, we do not expect them to fail just because they are not a financial viable institution. That's the reason why a very comprehensive standard is being created in form of IFRS 17, which interestingly has taken around 20 years to develop. It's a more than 2 decades journey for IFRS 17 to become mandatory starting 1st of January 2023, which means that all the global companies, all the insurance companies globally have already adopted IFRS 17, right? Earlier, we used to have an interim standard, which is IFRS 4 with the same name, but that's obviously been replaced altogether now. Okay. Now, think about it like this. If I say I'm talking about an insurance business, okay, what exactly an insurance business is all about? You would collect premiums, okay, which could be a small percentage of the claim or the cover. Right? It could be a cover against life in terms of a term insurance. It could be a cover for accident as a vehicle insurance. It could be a cover for losses against any business performance. It could be some kind of indemnity. It could be some kind of a mediclaim and stuff like that. So naturally, the premium amount is not very high as compared to the cover, and it all depends on a lot of other factors as well, right? So you collect premiums in a particular period, let's say year 1, and you may want to call it your revenue. Okay, but let's say, and you continue to pay this for years, just like a normal insurance cover. Let's say there is a claim which arises, I don't know, let's say year 4. Okay, so what my current accounting is suggesting, that I would continue to, let's say, recognize my revenue for the first 4 years. Okay, and then when the claim has arisen, somebody would have notified that, or I would have received an intimation that there is something happened, then I would bring that expense in. Now the fundamental problem here that you would all observe is that the matching concept itself is missing, right? Your related expenses pertaining to the revenue, they are arising or they are accounted for in a different accounting period versus the timing of the collection, or let's say time of recognition of revenue. And that is where IFRS 17 comes to play and asks, how does an insurance business work? If you know that well, bring that into your accounting and just achieve that objective of matching it. Okay, now just think about it. How does it really work practically? Okay, there is always an actuarial team. When it introduces any new insurance product, when it launches a new insurance product, it understands these numbers very well. It understands those matrices very well. That what is my expectation of premium? Okay. Of course, I have to take care of the fact that my compete is giving or charging a particular amount of premium. I may not be always able to kind of charge more than that. So I have some benchmark around. Okay. The studies would also help him understand the possible amount and timing of claims. It would also help him understand the expectations or expectancy of the claims. Okay. It would also help him how many people would continue and how many people would not continue, or the lapse that can arise in case of the insurance policy, right? And on that basis, they are able to gauge whether you should be launching that particular insurance product in the market at that premium or not. Okay, so when you bring them all along, the business suggests that yes, my premium receipt is happening in a particular period and my claims may arise in a different period. But in totality, if I look at the net present value of that entire business, if that comes to positive, it means that the product is successful, the product is profitable. Okay, that's the kind of a maths which is involved. And what IFRS 17 is exactly trying to do is bring that maths into the account. Okay, so what does it do now? It says that the receipt of premium is not my revenue. The occurrence of claims is my expense, but I'm kind of preponing that as well. Okay, I'm kind of preponing that as well and seeing to it how does that accounting flow into place. Yes, I believe that a net present value is nothing else but my profit, right? So I know at the outset If I'm writing this insurance contract or the group of insurance contracts, I'm going to make a profit. But the prudence concept would not allow me to recognize that profit on day one. So I'm doing the two objective, or I'm meeting those two purposes. One is I'm able to bring the matching concept and also the prudence concept into action, where I say that on day one, there is no revenue or expense and automatically no profit as well. Okay, my expectations of those claims and the related expenses would result into my revenue as well as my expenses on a notional basis. This is what is the fundamental shift in accounting done by IFRS 17 already. So what you expect to see is that on day one, since there is no profit, expense or revenue coming in place, we have a concept of something called as a contractual service margin, commonly referred to as CSM, contractual service margin. A margin I'm going to make because I've entered into a contract to provide insurance services to the policy. That's how you define CS. A margin I'm going to make because I've got into a contract with my policy holder to provide him those insurance services or the insurance cover. Right? That's how you start looking at bringing those actuarial teams calculations, considering the premium received, the amount of timing of the claims, the expectations of claims as well, lapses and other expenses into accounting. Now, mind it, it's still an accounting or a reporting standards. You don't expect yourself to become an actuary, but you start understanding the logic. You start understanding the business of insurance. And that's where, if you are already in the insurance accounting, or you wish to understand the business there, or if you're going to audit that organization, or if you are merely interested in knowing about what's happening in the IFRS world, IFRS 17 is the most sought after, most interesting standard to follow due to its own complexities and the kind of flavor it brings on understanding the insurance business. Okay, so when I say I'm looking at the CSM being recognized, it's a kind of a deferred income for me. Okay, so all those basic aspects, the basic principles of accounting are being, or at least are tried to be applied as far as the application of IFRS 17 is concerned. Right? So what does it mean? Me as an accountant, I'm expecting to receive inputs from the actuarial team. I'm trying to understand those inputs and formulate my accounting. Actuaries don't do accounting. Accountants don't do the actuarial modeling, right? But then they are talking to each other more often now. They're trying and understand each other better and trying to bring that reporting into place so that people can understand the business well. If you see a CSM in an insurance company's financial statements, it means it's a profitable entity, no doubt about it. But then, what if intentionally a company introduces a product which is meant to be loss making? Maybe they want to penetrate the market. They are charging lesser premium than they should have. Maybe they believe that the claims would increase. And after COVID, life has become really uncertain for most of us, those who have been affected. If that happens, then the expectations of claim can change and a profitable contract can also become loss making eventually. On that note, the prudence concept requires you to recognize losses on day one itself or as and when they are identified. Okay. So prudence at its core comes in place, right? There could be counter argument. What if there are some contracts which are profitable and there are others which are not profitable, but overall it is profitable in totality? So that's how the businesses would work normally. Okay. The fact remains, the prudence still requires you to recognize that loss on day one itself, and the profit will be recognized over the period of time. That's how you start building it up. Because in the current accounting, it was absolutely impossible for people, the users of financial statements, to really assess that which of these contracts that the companies are writing are actually profitable and which of these are not so profitable. Okay. So on this note, what IFRS 17 would require you to assess is you need to look at grouping of insurance contracts on the basis of the profitability, on the basis of the risks, and also on the basis of the timing. Okay. Profitability, risk, and timing. I'll start with the risk one very quickly. If I'm writing a term insurance, it is very different from a motor or a vehicle insurance. So there would be two different groups. There would be two different categories. Within term insurance, let's say if I'm writing a term cover for somebody aged 60 plus, okay, I might believe that these could be loss making. But if I'm writing it for somebody who's a 30 plus, this could be profitable. Similarly, for vehicles, if I'm writing it for a family car versus a cab that operates commercially, this may be a profitable one because the car is, not really used very often. It's a very safe drive done by the family, but this could be exploited entirely and becomes a loss-making or an onerous contract. Okay. So the way you start looking at it, my contracts, which are insurance contracts for term, would be separately grouped for loss making versus profitable. Similarly, for vehicle, I would have another grouping for family versus cab, because from a risk perspective, these two are distinct, and then these categories are also distinct from the profitability standpoint, which means I'm talking about a minimum 4 groups here. If I'm writing 4 different contracts, they would fall in 4 different groups, and the accounting will be done separately at each group level, right? But then timing has a role to play as well. My standard requires that I cannot group 2 contracts which are 1 year apart. It means that I have to follow a timing, that even if I'm writing, let's say I'm writing term contracts every day. I started on 1st of January 23, and I'm all writing these profitable contracts. How far can I continue to group those? Up to 31st of December 23, which means that the next contract, the next term contract or term insurance I'm writing on 1st of January 24, for example, that would be falling under a new group altogether. Okay. So these are all the peculiarities to start with. These are all the peculiarities to start with, which IFRS 17 tries to offer or requires you to understand in depth. But mind it, this is the starting point where we say that you're talking about insurance contracts. One of those important businesses that an insurance company does is also around investment service, just like a mutual fund. Okay? You're collecting premiums on behalf of policyholders, you're collecting monies on behalf of policyholders, and you may be investing those in some security. So there are investment services involved. So how do you account for those then? Because you are kind of acting, as an intermediary on behest of those policyholders. Then the accounting changes. Then you bring the fair value aspects as far as investments are. But then, what if you are writing an insurance contract which includes both the insurance component as well as the investment? Standard now requires you to split them across. And it requires them to be separately accounted for because it would work under two different models. Okay? But then, doesn't it sound too complicated here? To be honest, yes, it is complicated. To be honest, it was meant to be complicated if something takes 20 years in making. So what the standard has done, it has taken one more simplified approach, where it says that if your insurance cover or the policy period is less than 1 year of time, you can simply account for it on a cash basis. You receive money, you recognize revenue, you have expenses, account for it on a cash basis. That's what you do, right? So many contracts which are like, you have something called as a P&C, property and casualty insurance, where you have vehicle insurance, fire insurance, theft insurance, business loss insurance. They're all covered under that particular category, and many insurance companies would be happy to use that as a part of their accounting because they know that's a simplified way of doing the account. But nonetheless, the moment you come into a life cover, the moment you come into something which is a long-term care, could be a lot of health contracts for that matter, then you have to still look into talking to those actuaries, trying to get a perspective and do the accounting and reporting around. Okay, so as an accountant, it becomes now imperative for me to know the insurance business well, and what could be the easiest way or the most beautiful way than to use the standard to be able to understand the industry itself. Okay, so the program that we have brought in is all about knowing IFRS 17 to the industry, taking a lot of examples, case studies, and questions to learn about IFRS 17 and areas around that. Look forward to connect with you. We'll be discussing this at length in this 25 hours approximately coverage that we are doing with a lot of downloadable notes and multiple choice questions and a certification to follow from Eldine as far as this standard is concerned. So welcome you all again. We'll see you around in the program. Thank you very much. All have a good day. Bye-bye.